welcome to another Barometer readings. Good afternoon. I'm James Callahan. I'm a portfolio manager here at Barometer, and I'm joined by a crack team. So we have Diana Avigdor, our head of trading. We have Amit Joshi and Brian McNichol, who are also portfolio managers. Dave had something important come up this afternoon, so he's not going to be able to make this call, but he's left you in our more than capable hands. So there's obviously a lot to cover this week. I'll get started with some macro comments that Dave asked me to share. We'll then have Diana give some trading color. We'll talk Trump implications, as well as some positions we like and some things that are going on right now. So to start with macro, we're feeling more positive on markets after the price action last week. The S&P flirted with an outside reversal, but managed to avoid it. We've gone through some nice digestion over the last few weeks, and we've come through on the other side with a big volume update on Friday and some decent price action today as well. A few more things that Dave normally covers. The SPY versus aggregate bond index did make new highs, which is positive for equities. The value line geometric index seen here, it held its trend line. The volatility index did come back down, which is shown here, back to normal levels. And Bitcoin shown here through the IBIT ETF is working well. So it feels like market's going a bit more risk on. So this, alongside our 4 short and 1 long-term indicators reversing up today, we're more positive. We put a bit of cash to work today with a view to further reduce our cash balance over the coming days. So with that, I'll stop and I'll ask Diana to come on and to talk through some of the things that she's seeing.
Good afternoon, everyone. Thanks for joining us. The last couple of months have been pretty treacherous, lots of moving parts, and it became very hard to establish correlations and be able to explain, much less predict what will happen. I think that we're going to have a lot of headline risk in 2025. We do have a second Trump administration, so every day is a new day. So we look at the market's action in order to infer proper correlations in hindsight, so we may be able to predict what the sensitivities towards volatilities might be in the near future. Looking at what happened over the holiday season and year to date, what we observed on the trading front is that there were and still are a lot of people very heavily invested in equities. And why not? We just finished 2 very excellent years. On the next chart, what you will see is households own 39% of cash equities in the $92 trillion US equity market, and a large portion of active mutual funds, 18%, and passive ETFs, 9%. So there has been some year-end tax-related selling in the last few days of 2024 to offset some gains. This exposure that I'm talking about existed even though until not too long ago, almost 100% of people were asked that if you ask them, we're going to go into a very deep recession due to the speed with which central bankers were raising rates. Economic data and importantly earnings held in though. And today, however, everyone you talk to is saying that it's inflation that is their biggest fear. This is because when non-farm payrolls hit at the end of last year with an excellent employment report, the possibility of rate cuts dimmed, and with that, the market had to price in higher rates for longer. In the next chart, you will see what happened to the bond market as rates were going up. This coincided with the end of year rebalancing, and what we saw was a little bit of exposure taken off the table. From the high level of exposure, that meant that equities moderated, but the bond market experienced the worst long-run return in 90 years. Moving forwards in the presentation, we've seen some movement in the commodities long-term, and this despite the fact that the dollar kept its strength throughout this period. This was purely a reflection of the great economic data that was coming in. And so it's a high-class problem to have such a great economy. But yes, inflationary fears started to come in. So with oil starting to trade better, profits were taken on technology stocks, and they were plowed into U.S. energy. And yes, drill, baby, drill talk from Trump, but also less regulation and increased demand. The exposure on oil in the next chart will show you that it was pretty low, so lots of room to add. Moving forward, just a couple of more pictures on the sentiment, which is really a fickle thing. It went from really high, you'll see in the next one, to really low. In fact, the current AAII bullish sentiment reading sits at its lowest level since November. So we went from euphoric to really low. And as James mentioned earlier, as the market started acting a little bit better, this means that we're in a pretty decent footing from an exposure perspective. Moving forward, economic data started coming in a little better with CPI in line, and it was good. In other words, not high. We were seeing investors starting to dip toes back into the market and seemingly finding a little bit of footing. Earnings season is helping with this. Financials started with their reports. We still have 3 weeks of very high reports. Netflix just reported tonight's trading up about 12% as I speak. But financials, which we've been pretty bullish on all year, we're happy to see that earnings have come in pretty good, and so flows have returned to the sector in a time when exposures were really not that overweight. And then finally, I just want to bring everyone's attention to longer term, and I know I'm the short-term girl, but longer term, the market depends on two things: macroeconomic data and earnings. This is the US nominal GDP of almost 50% in the last 5 years. So say what you will in terms of all the walls of worry that we need to go over. When you have this kind of situation followed by earnings in the next chart, we're expecting 8% earnings with 11.5% margin. I think it's hard to bring up a bear market into this, but these are the two things that the market's watching: rates, earnings, and macroeconomic data. And those are the correlations that we're seeing the highest.
Thanks very much, Diana. That was great.
Pleasure.
So I'll just jump back on quickly to run through some things before we bring on Brian and Amit. Obviously, it's top of mind for everyone. We've seen a good chunk of the executive orders that President Trump plans to sign to get things going. Most of them were social and had limited impact on financial markets, but there were some, of course, that do have impact on financial markets and definitely some that impact Canada. So we'll talk through all of that and hopefully answer some questions. And there's a lot of words on these slides. I'm happy to send them to anyone because I'll go through them pretty quickly. Just reach out to me at jcallahan@barometercapital.ca and I'll send those through. So on tariffs, it was considered positive for global currencies and weaker for USD yesterday when, rather than implement blanket tariffs during the first big executive order barrage, we got a directive to a handful of government agencies to study the impact of tariffs. This wasn't surprising. Trump legally needed to do this in order to levy tariffs against pretty much any country except for China. Later in the evening, though, he did give a statement that he does plan 25% imports on 25% tariffs, excuse me, on all imports from Canada and Mexico beginning February 1st. So there were a few other important things mentioned. Primarily, I would say the executive orders in regards to energy policy. We did get a national energy emergency declared, and that should be great for some of our positions. But I'll leave it there because I want to bring Brian and Amit on to talk through the Canadian impact to all of this.
Perfect. Thanks, James. I'm not sure if you want to just go. Awesome. So yeah, I mean, this was a topic we dove into a couple weeks ago on this call, and as discussed, we remain of the view that Canadian energy exports would not be included in the wave of tariffs from the U.S. As such, we haven't really made any changes to our Canadian weightings. We still sit at 22% energy versus 17% for the TSX, and we steered clear of the subsectors that we believe would be included. So once again, that includes the automotive, consumer, agriculture, and lumber space, just to name a few. We have virtually zero exposure to these subsectors. Canada represents 60% of US global imports. So this is a massive number that they're going to have a very hard time replacing. And the fact of the matter is, the US relies heavily on Canadian heavy oil for their refineries. And I'm going to pass over to my colleague Amit. I know he's got some charts he'd like to share, just highlighting this topic.
Thanks, Ryan. So yeah, we've heard a lot from Trump in regards to energy security and blanket tariffs on Canada and Mexico, and definitely energy is an important sector, not only for our economy, but for our stock market as well. Replacing the imports of oil from Canada, it's a bit easier said than done. This chart's from our friends at Cornerstone Analytics and just talks about the productivity of U.S. oil production, and it's been declining over the last 5 to 7 years, as you can see from this chart, off of a pretty big base. So what that kind of shows us is the economics of the oils, the shale drilling that we've seen isn't as productive. When you look, maybe James, you can go to the next chart there. Iran is definitely in the crosshairs. That's for sure, and that's probably a bit easier for the Trump administration to sanction. But when you look at Canada directly and the makeup of our oil being heavy oil, and that's what's used in the American refineries, that's hard for the U.S. to replace, even if they are drilling much more oil domestically. The U.S.'s oil is more light oil in general, and their refineries aren't set up to use that. So when you look at, I think it might be the next chart there, James. Um, this is the amount of crude oil by country that the U.S. imports, and 60% of those imports coming from Canada themselves. Majority of that is heavy oil, which is very important to the refineries. If you try to tuck that away, great. This chart is helpful. So this is the domestic production from the U.S. itself, and as you can see, out of the almost 13 million barrels a day that the U.S. produces, about 77% of that is light oil, and it's not set up for their refineries. The heavy oil, which is about 410,000 barrels a day, only about 3% of their production. That's that's what Canada provides. If you go to the next chart, James, the heavy oil is what's required. And if you were to look at replacing that, if not from Canada, from other jurisdictions, that would add about 40 cents a gallon to the consumer at the pumps. And that's not something that the Trump administration is going to look at. So, we do feel pretty good about the energy sector in Canada and the U.S. When you look at the performance of Canadian energy names, they definitely have been lagging their U.S. counterparts on the back of tariffs, and we've seen that already. It's always hard to extrapolate how much of that is priced in at this point. There probably is more headline risk, but we feel pretty good about the likelihood that the tariffs themselves on Canadian energy, if they do come, are probably much less than the 25% advertised. But it's a topic we're definitely keeping an eye on, and we'll definitely provide more updates as they come through.
Thanks a lot, guys. And that's I guess I'll just make a comment. Diana mentioned it as well. Amit, do you just mind going on mute? Thanks. Diana mentioned it as well, and I have my computer set up to do this presentation, so I can't get into the numbers. But Netflix is a position that we have been adding to over the last months, and it's quite a big position for us. They're trading up 10% in the post after reporting earnings. So really good results. Our idea on Netflix is that if you look at it generally, around 10 years ago, Netflix realized that they needed to get serious about content production because they saw coming down the pipe content producers looking to get into streaming and increasing licensing costs. So they began investing very heavily in production. They lost money for years doing it. Eventually did figure out how to produce content, and they've been, very successful with it over the last 10 years. They have gotten quite good. Meanwhile, a lot of content producers did come into the streaming market and have realized that it's actually tougher to make money in streaming than they thought. So the content producers have started to pull back investment. They've started to make content licensing cheaper for Netflix as Netflix has figured out the content production piece. And so right now they're really firing on all cylinders. And I would suspect that when I look through the numbers, we'll see a big beat in terms of sub growth for the quarter. Because they've had some exciting programs on the platform. The Tyson Paul fight earlier in the quarter, very interesting. The Christmas Day football, also very interesting, and some original content that's done quite well, like Squid Game 2. It seems to be doing well. So good numbers there. That's a good result. With that, I'm going to end the screen share and we'll have a look if there's any questions. And I see no open questions, so we must have done quite a good job. As always, it's a pleasure. Please reach out if you have any questions. And we're always happy to chat and have conversations. We're happy to do these weekly calls. So thanks all for joining. Thanks Amit, Brian, Diana for joining as well. It's been a pleasure, and we'll see you guys next week.